new surroundings. I am trying to find ways to make life a little bit easier for myself and to manage the workflow. So slightly different surroundings, but today we're going to take a look at a company that only just floated on the FTSE 250 back in 2021. So brand new company to take a look at. Let's dive in. Hey there guys, welcome to the FTSE Show, episode number 60 now. 60 episodes in, second season. So hope you are well. If you're enjoying this series, do me a favor and drop the video a like. And if you haven't subscribed to the channel yet and you are watching these videos, then please do subscribe. Releasing some different stuff at the moment. We're doing the FTSE Show, but we're also doing a new documentary that I want to do to bring people along for the ride, where I'm turning 4K into £1,024,867. And I think that's going to be a really interesting journey. We're going to literally show you the highs and the lows of trying to get there. I am 100% convinced that I will achieve it. I've given myself 23 years to do it. We're getting close towards the third year now. So we've still got another 20 years ahead of us yet. It's going to be a long old journey, but I think it would be very cool in 20 years time to have a record on YouTube of all the years we went through and episodes detailing the entire thing. So if you haven't subscribed yet and those sort of things might interest you, if you're an investor in UK stocks or it's something you're looking into, then subscribe to the channel and you'll be notified as soon as new stuff comes out. I'm always experimenting with different ideas. Today we've got a company that only floated in 2021. They've been around for a lot longer, but they only floated in 2021, and so we're going to take a look at them. It's a company called Moonpig, a well-known household company, household name. They have a well-known advert and a jingle that most people will know, and but they've been around since 2000, and they only floated in 2021. And so I thought, now we've got a couple of years worth of annual reports, it's worth the time to take a look and see what we're looking at as a potential investment opportunity. So the company was founded in 2000. In 2004, they launched Moonpig Australia, so they started to expand overseas, and that was the first year that they added flowers as a gift option. They launched the first TV campaign, the jingle that everybody knows. That was back in 2006. They then launched Moonpig USA in 2010, so they're now in USA as well. They then made quite a big move and acquired a company called Greets in the Netherlands. That was back in 2018, and Greets make up a big chunk of the revenue of the Moonpig Group, which is why they're now called Moonpig Group PLC. The Moonpig app became the #1 shopping app in the UK back in 2020. They floated in 2021 and listed on the FTSE 250. They are the #1 in the UK with a 68% market share, and that actually jumped up from 60% in 2021 to 68% in 2022. So they are head and shoulders the leaders in what they do in the UK, which is essentially cards and gifts. And then Greets in the Netherlands are also #1 in the Netherlands, but they have a 67% market share, and that was 65%. So here we've got Moonpig and Greets both expanding and growing and also gaining more market share on a year-by-year basis at the moment. So that's quite cool. 61% of their customers are female, which I suppose you probably expect. I think the ladies are more inclined to remember birthdays and things like that. Blokes are generally pretty useless. 77% of those 61% female are 54 or under. 87% of revenue comes from existing customers. So a large number of their customer base are recurring business. That's a good business model to have. You're not always having to therefore find new customers every single year, when a large proportion, the vast majority of your customers are going to be buying more every single year. So that's a kind of a good recurring revenue business. 70 million customer reminders were set up via their app. So they have this app system. I've never used it, I've never looked at it, but through the app, it seems like you can set reminders to notify you of when birthdays or certain events are coming up in your life. And they have 70 million people now using that. That's up 20 million. So it was at 50. It's gone up 20 million in just the last year. So it's been widely adopted right now, because 20 million in a year additional users on top of the 50 million you already have is quite a big jump. They have 2,400 SKUs in the gift range. SKUs are essentially units of products. Every different type of product or different type of gift will have a unique SKU number. That's what they call them. So they have 2,400 different types of gifts, essentially. They got 43,000 card designs. That jumped from 27,000 last year. So they've gone from 27,000 to 43,000 card designs in 1 year. So they've been really working hard on developing some new designs, which kind of is a good thing. They have 76% of their revenue comes from the UK, 23% of their revenue comes from the Netherlands. So this acquisition of Greets was obviously quite a big deal, because it's representing a quarter of their revenue. So that was quite a big acquisition for them. 1% comes from the rest of the world. So that's your US and your Australian aspects of the business. So those areas are only representing or contributing 1% to the overall revenue. So they're very small right now. Bear in mind, Australia was launched in 2004 and USA in 2010. You would probably hope that they were bigger than that by now. You know, I mean, if Moonpig Australia launched in 2004, we're getting on for 20 years since then, and they're still, combined with the USA, still only representing 1% of overall revenue. I think that's a shame, personally. I think I would, as an investor, I'd want to see the Australian arm of this business contributing far more after 20 years. But it doesn't seem to have taken off. It doesn't seem to have grown over there at the moment. And as an investor, you might want to delve into why that might be. Why is it not taking off in Australia? Have they made any comments on this? Do any of the annual reports reflect this or cover it in any way? 54% revenue comes from cards, 46% from gifts. But what we're tending to see in the last couple of annual reports is that the shift of balance is changing. So the revenue from cards is dropping, the revenue from gifts is increasing. And I don't mean in terms of the actual revenue from cards on a financial sense is dropping. It's actually growing each year. But the balance between the two, so the cards revenue might be growing on a financial basis every single year, but the actual percentage in terms of the representation of the revenue is that they're actually starting to see more of the revenue that they're making coming from gifts than it's coming from cards. And as you'll see as we get towards the end of this episode, it looks like Moonpig and Greets and the group itself are starting to look into expanding into the gift section rather than trying to expand further into cards, which I imagine kind of makes sense, because after 20 years of dominating the card industry, there's probably not a huge area of growth other than trying to expand into different countries and trying to be as dominant in other countries, which is something that I would want to see as an investor. Certainly I'd want to see that's what they're trying to do, but it would kind of make sense that they're looking into the gift section as well to see if they can grow that aspect of their business to increase revenue and increase shareholder value. So diving into the analysis then, we've only got 3 years, excuse the typo, which I've literally just seen as I'm looking at it now. I'll have that changed in the video post-production, so you probably won't even notice it, which is, I should shut up. So we've got 3 years worth of financials here. We've got 2020, 2021, and we've just had 2022 come out. So looking at the revenue, 2020 was the year before they floated, essentially, also hampered, of course, by the pandemic, various lockdowns. However, Moonpig are an online-only business, so will people have stopped buying greetings cards through Moonpig during lockdown? I'm not sure that they would have had much of a difficult time as other companies have done. I think they would have done okay. The annual report suggests 2020 was a hard year for them because of the pandemic. I don't genuinely see how that would be, because they're an online-only business and that wasn't affected. So you would expect them to do just as well during the pandemic, personally. But 2021 was a much better year, and we saw quite a big jump, and the IPO may have helped with that in some way. But revenue definitely made a significant leap to 368 million. And then in 2022, we've actually seen that drop off. Now, I've read the annual report. They don't really mention why that's happened. There's not really any mention from the chairman or the CEO as to why they think revenue has dropped off. However, what they have said is that they expect in 2023 revenue to return back to about 350 million. So it's a strange one. It's not going to be any costs involved, because we're talking just pure revenue. We're just talking about what's coming in to the business. This hasn't had anything deducted from it. This is just raw money coming in, and we've seen a drop off in 2022, and they don't really address it, which is a bit of a concern for me, because I prefer the transparency of knowing why these things are happening, and when they don't even address it, it's a bit strange. Cost of sales, that is essentially the cost of being able to sell what you're selling. So we're not talking about necessarily business expenses of running the business. We're talking about the cost of the materials and the cards themselves and the printing and that sort of thing. So that's been deducted off. That gives you your gross profit. Gross profit's looking relatively healthy. I'm not got any issues with that. You look at the gross profit percentage, which is essentially what profit is left over of the revenue as gross profit, and you can see that percentage has been dropping down slightly year on year, but it's still comfortable. I wouldn't have any necessary concerns about that. That's fine, unless the trend was to continue over the next 3 or 4 years. Then I'd start to wonder, why is the cost of sales growing faster than the revenue growth? But at the moment, that's all good. We can look at expenses. Obviously, expenses jumped up in 2021. They've jumped back down in 2022 relative to that revenue. And so when we look at the expense percentage, we're looking at that as a percentage of the gross profit, not the revenue, the gross profit. And you can see in 2021, the expenses were just too high, which is why it's coloured in red as a red flag in a way. 80% expenses, I don't like that, but we've seen that go back to 68% in 2022, which is more my level. This is the kind of levels that I'm particularly comfortable with, so that's fine. And then you've got your operating profit at the bottom there, so you can see how things have worked out quite well actually for this company in terms of operating profit over the last few years. We're seeing some growth in the profit. Going on to the earnings analysis then, so we've got our operating profit across the top now. Then you've got your finance expenses. So notice 2021, 2022, the finance expenses is essentially the interest you're paying on debt is high. That's quite high. I don't like that. And so we've got red flags for 2021 and 2022 there, because the money, that's essentially they're paying 9 million a year just on the interest, which is quite high. So yeah, not so cool. Then we've got a sale of assets. We've got our other income, which could be anything. And then we've got taxes, which there's no point going into really. So then we come down to our reported profits, but then if we take off the extraneous other income, then we can actually work out what our true profits are. This is a company that made 30 million in profits in 2020. They saw that drop down to 19 million in 2021, and then they're back up to 30 million in 2022. Looking at that as a percentage of profit against revenue, they're riding at about 10% right now. And that's okay. That's really not bad. This is a company that they're not making a loss. They had a really good 2020. Then obviously the IPO happened. Now a lot of costs come into floating on the stock market. And what we tend to see with IPOs is that the first couple of years of floating are relatively ropey from a financial performance point of view. Not always, but quite common. And this is because they often have some quite astronomical costs in being able to float. There's many costs involved. I don't necessarily understand or I haven't really put much work into understanding why or what those costs actually are, but it's something that I've seen a massive pattern of. Any companies that float, usually first couple of years, they have to borrow a lot just to pay the administrational costs they might be, I don't know. But we'll see in a moment. Moonpig did take on quite a lot of debt to be able to do this. As a result, that's obviously going to hamper the profits, and it has done, and it knocked the profits in 2021 down to 5%. That's still okay. For your first year as an IPO, after taking on a load of debt, to have 5% profit, still profit. It's still 20 million in the bank, So yeah, not bad at all. And in 2022, they're back up to just shy of 10%. So I like that. I like that situation as it is right now. What it says to me is that this has potential, but it isn't necessarily lighting my world on fire right now. It's not something that I would be running towards right now, but it would be a company I'd want to be keeping an eye on for sure. Looking at the debt analysis, so we've got our true profits now across the top. Then we've got our short-term borrowings and then our long-term borrowings. And the thing you probably want to pay the most attention to here is those long-term borrowings in 2021 and 2022, because they jumped from outstanding borrowings of 11.4 million, and that's jumped to 180 million essentially in 2021. It's gone up a little bit in 2022. So that really doesn't tell you much on its own. What you have to do is then analyze that against the earnings power of the business. Are they biting off more than they can chew? Are they borrowing far more than they can afford to pay back? So then we take the earnings and we run that against the debt, and we have what they call an earnings to debt ratio. It's got many different names. Different people call it different things, but it's the same ratio. All it essentially is a number that will basically tell you how many years worth of earnings is it going to take at current earnings power to pay off that debt. And at the moment, that's too high. What it does tell you is that they're biting off more than they can chew. They are actually doing that. So the debt that they have at the moment is representative of 6.2 years worth of current earnings power. That's too high for me, unfortunately. It's above what I want to see in a company. It's the reason why they're paying 9 million a year in interest on debt. And it's just a bit too much. And what I'd want to see as an investor, absolutely, is them paying that down. I want to see that reducing. At the moment, it's still going up. And so whilst earnings have gone up in 2022, which has reduced that earnings to debt ratio, I still don't like it. And I would certainly want to be seeing the long-term borrowings being eaten away at. That's probably what we will see happen in 23, 2022, 2024, 2025. We probably will see them start to eat away at that, because we are at very, very early days at the moment in this journey for Moonpig, following the IPO, following the float on the FTSE 250. They probably will spend the next few years paying that down, and so what we'll see is the interest on debt reducing, and hopefully profits will improve. As it stands right now, this is, again, what this is saying to me is that this is a company that I'd want to keep an eye on with a view to buy one day, but at the moment I'm not rushing to it. Looking at the equity analysis, this is another issue for me. So we've got our assets, so all of the assets in the company, everything they own, the cash that they have in the bank, the intangible assets, the rights, the licenses, all that kind of stuff, the inventory that they currently have, all of the assets the business own, added together as a financial value, and then you subtract the liabilities they have. Now, the problem here is that in 2021, 2022, they took on all that debt. Debt is a liability. So the debt that they've taken on have actually knocked the company's net worth into negative territory. They now have negative equity. That's an issue for me, unfortunately. I don't like to invest in companies with negative equity for obvious reasons. They can't, at the moment, if they were to liquidate the business, they'd have 173 million in assets, but their liabilities are nearly 242 million. So they wouldn't be able to pay off their liabilities. So that's a bad situation. A snapshot of time right now, don't like it. That looks like it's improving. It looks like as they're going to hopefully pay down that debt, increase their assets, grow the business, hopefully make more revenue, more profits, that we should hopefully see that net worth get back to positive territory. But as it stands right now, again, it's just not looking good. Now, don't forget, this is an IPO. So this is a brand new company on the stock market. They've taken on these debts because they've had to float, and it takes a few years to get back into the swing and back into the flow. But it is something that at the moment I'm not so sure about it right now. Let's take a look at the pricing analysis then. So I've worked out essentially based on the earnings power of the business and taken also into account the equity value of this business, i.e. what you get in for your shares that you're buying in terms of value. Well, they've got negative equity, so that's bad. So we're not keen on that. And then when we actually look at today's price against what I would pay for it, for me, anything over £1.50 is overpriced. It's just too expensive. You're not really getting a decent deal. Today's actual stock price at time of recording is £2, and it has dropped off quite considerably since the IPO, but it's still not low enough for me. Now, even if it was at £1.50, even if it was at £1.30, would I buy this share? Personally, no. Personally, it's just a bit too early for me. As a company, I want to see more of a track record. Now, sometimes what that means is that we can be late for the party. If we wait too long, we could end up not having the opportunity to jump in and missing the boat, if you will, or being late to the party. I'm comfortable with that, and I always have been as an investor, very comfortable to wait and be sure of something and get in late than to turn up early, try and get the best deal I can, and then find there's no party there to go to. Does that make sense? And what I find a lot of beginner investors do is they want to be the first people to the party. They want to jump in now whilst the share price is at its lowest and hope that things turn out good. And what you'll find with that strategy is that, and this is a big reason why so many beginner investors lose, is because they jump in and they do that, and then they find that the investment was a bad investment. And yes, they got in cheap, but it won't make them any money. What I prefer to do is look for a track record where a company is doing really well. They've proven that they're going in the right direction. They've got a wonderful growth strategy that makes perfect sense to me, and they're priced at the right price. Then I will jump in, and that's what works for me. That's why we get 17% annual average return over the last 9 years. So I'm going to round up now. We're going to round up Moonpig. So obviously, first point straight off the bat, very early days to be able to properly analyse this business. It's a bit difficult. The IPO has added significant debt to the balance sheet and is effectively... I'm just going to adjust this mic because it's really peeing me off. It's destroyed the net worth, as we've seen from the equity analysis. Debt levels are higher than I would want to see. And interest on debt is high and significantly eats into the profits right now. Not to the point where it ruins anything. I mean, they're making 30 million a year at the moment as it stands. That's decent. But they'd have extra millions on top of that if they weren't having to borrow so much. And I'm not criticizing the borrowing because, like I said, it's something that they've had to do to be able to float. And it's some things you just have to do to be able to get there as like a means to an end. But it is still a concern for me in terms of the level of debt they've had to take on to achieve it, and it just means for me it's too early in the process. Revenue fell in 2022. No real explanation as to why that happened. That's a slight concern. That's something that would be on my radar as an investor. They launched, there's some news for 2022. So they launched Moonpig Ireland in 2022. So this year they've just launched the Ireland website, and apparently they've actually got Irish themed cards. So they've changed some of the designs. Only about 400 out of the 47,000 or 43,000 designs. 400, it's a very small amount, but they've got some specific Irish-based card designs, apparently. And that's coincided with a launch of their Moonpig Ireland website. So it looks like a planned expansion into Ireland. They're trialing Moonpig Plus subscription service. Everyone is doing this right now. Every company out there is running a subscription service or trialing a subscription service. And Gary Vaynerchuk, I don't know if you follow Gary V, he's been saying everyone's going to be doing this for the last 5 years, and now they're starting to do it. So the guy was right. They're trialing a launch of a UK jewellery range to kind of complement their gifts. So that's an interesting little experiment. Often these trials sometimes don't work out, so it doesn't necessarily mean that they're going to become a major player in the UK jewellery scene. But if it works, then it might add revenue. They are teaming up with Virgin Wines and Calf Kids and Flowers. So these are decent brands, well-known brands that they are teaming up with to complement their gift options. They've also announced this year the acquisition to buy a company called BuyAGift. And again, that's obviously to complement expansion into the gift markets. Remember, we were talking about the percentage of revenue that's coming from cards, the percentage that's coming from gifts, and it seems like the contribution of revenue for the business is certainly increasing when it comes to gifts, and it looks like gifts is going to be Moonpig Group's focus for expansion, certainly in the next few years in the short term. The board have announced that they expect revenue to return to about 350 million in 2023. So if you remember, they were at 368, I think it was, in 2021. So they're making a jump back towards where they were in 2021, but still not quite achieving that. So, maybe we'll see record profits maybe in 2024, 2025 as they finally, surpass that 360 million revenue level. If things go well and growth continues to go well. They are aiming for 15% annual revenue growth per year. That's what they've been saying in their annual report. Now, 15% revenue growth a year is fantastic. That's really good. So if they achieve that, then I think this is definitely a company to pay more attention to. I think this is a decent little business. They need to pay down that debt. They need to get through this IPO phase. And they need to kind of settle things down as a business. With all of this expansion and growth into gifts, if this works, then in a couple of years, this might be a pretty decent looking little business and maybe a stock to invest in. For me right now, I want to see more established performance. I want to see things moving in the right direction. Then I might consider buying. Would that make me late for the party? Yes, it would. But I would rather do that than invest now at £2 a share, which is a little bit too high anyway, and then find that none of this works out and there's a company that's just not going anywhere. I would rather, and when you are in a situation where you've got 54 stocks on your watch list that are in a better position than this, it doesn't make sense when you have capital to put to work that you would put it into your 55th favourite stock when you could just put it into your top favourite stock. Does that make sense? So for me, not something that I would be interested in right now, but I will be keeping a close eye on Moonpig over the next coming years and certainly checking out their annual reports as and when they get released. So looking at the scoreboard, they've come in at -3 points, and a big reason why they've taken a hit on the clean score is essentially the equity, the fact that they are in negative equity, and the fact that they have debt levels that unfortunately have been rising in the last 2 years. So we want to see debts coming down. We want to see the equity rate improve. If that gets achieved, that clean score will improve and they'll start to move into positive numbers and start probably moving up this leaderboard. But as they stand as a snapshot right now, it's -3. But I would say definitely one to stick on your watch list and keep an eye on. Not a terrible company at all. It's a company making 30 million profit a year. They haven't had a losing year yet. You can't complain with that. So, but I think they're just slightly overpriced right now. So that's it. If you've enjoyed the show, please like, please subscribe, please leave a comment, please let me know what you think, and I'll hopefully see you soon. Cheers, guys.